It is indeed a great pleasure to be with the folks from Urbana again. I have the privilege of speaking at this event on an annual basis, as well as at the annual general meeting for the Urbana team. And again, on behalf of the employees and shareholders of the Canadian Securities Exchange, we've been intensely grateful for the support that we've had from Urbana since they made their significant investment in 2012, and there was an earlier investment in the organization. And truly, without that support, we would not be anywhere close to where we are. In fact, we probably wouldn't be. So again, we have, again, an intense gratitude for the support that we've received from Urbana over the years. So the reason for the walk-up music, Bruno Mars, is that as you can see, all that glisters is not gold, but close. So borrowing from the Merchant of Venice, of course, I'm sure all you Shakespearean scholars out there recognize the quote immediately. Talk a little bit about what we've seen over the last year and what we're looking at in the year to come. Again, as George says, it's probably chaos and hard to predict, but as I say, we'll see some interesting developments. But for those of you who aren't familiar with the Canadian Securities Exchange, we are, in fact, last year we celebrated our 20th anniversary as a stock exchange in Canada. We have offices in Vancouver and our headquarters here in Toronto next door. And as you can see, we photoshopped the Bank of Montreal logo off of our headquarters building across the street. Which is not, of course, any reason that took them years to add us to their discount brokerage access, and we don't bear many grudges, but yeah, that one we do, actually. And we have a very, very clear focus in what we do, and that is to basically to provide the lowest cost of capital for Canadian public companies. And a particular niche where we can deliver value is in the early stage or the small cap space in Canada. And we have had tremendous success, particularly over the last 13, 14 years in listing more new active companies, not only than any other exchange in Canada, but any other exchange in the world, which is really cool. So last year, at this time, talking to anybody in the small cap space would have told you these are the worst markets they have seen possibly since the global financial crisis, possibly since the tech wreck, or maybe even ever. We had high interest rates. We had tightening monetary policies from a variety of governments. Commodities prices were being hammered. Lithium, graphite, the so-called battery metals, which were the darlings 2-3 years ago. I'll say it out loud. The Chinese are manipulating the price of copper, lithium, graphite, nickel to prevent companies in the West from developing new sources of supply for the battery industries. The one area that they don't control, of course, are the precious metals and uranium. And we saw the market react to that over the course of the year. And beginning with interest rate cuts, loosening monetary policy in Canada, the United States, and other Western economies, we began to see some positive movement in the junior capital market over the course of the year. Now, on balance, it wasn't terrible. Companies on the exchange listed slightly more than $2 billion last year. Meaningful capital, real companies putting that to work, hiring people, research and development, exploration, adding to the wealth of the Canadian economy. And the activity was also profound. We're looking at transactions of almost 4 to 5 financings a day. Now, they're not large, but money was being found. Good projects were being supported, good management teams were being discovered by investors and supported. So, again, as I said, 67% of the new issues that came to market last year were in the mining space, and almost exclusively in the exploration side. We have a few producers on the exchange, but the vast majority are exploration companies. Trading was terrible. We can see the numbers up there. For the first 7 months of the year, it really began to recover in October and November. The December numbers will show a little bit of a drop, but we don't have that many trading days in December, so that's a natural par for the course. But we are hopeful that that's a leading indicator to more listings and more financing activity because the turnover numbers are going up. And that's been, as I say, a very positive trend that we are riding into 2025 so far. Couple of things. The organization was also significantly more profitable in 2024 against all of the headwinds than we were in 2023. And that's because we managed to implement some changes to our market data policies. Again, I'll quickly backtrack. An exchange makes its money basically in three ways. Take a small slice off the trading business, so trading fees. Listing fees, of course, you charge companies when they list and then to stay listed on the exchange. And then the market data, so the information that's generated by the trades, the quotes that are produced over the course of the trading day. And ideally, you'd like to have those more or less in balance. Mature exchanges tend to think of a third, a third, a third. In some years, again, because of our fast growth on the listing side, the listings revenues have been high, and the other revenue sources relatively lower. But as I say, what we're looking to achieve is a relative balance amongst those three revenue lines. But market data was the shining star of the year last year. Couple things of interest in the coming year, and these aren't earth-shaking, but we are going to add CBOE securities to our trading list. We currently trade TSX and venture exchange stocks competitively against the other marketplaces operating in Canada. And so we've rounded out the portfolio with the addition of the CBOE stocks. And we're adding a market on close facility. I keep wanting to say by the end of Q1, and the tech people keep telling me that it's going to be later than that, there are harsh words exchanged. But the point of a market on close facility is twofold. One, to permit companies that are eligible to be in ETFs, or to make it more easy for the manufacturer of that ETF to include our companies in the ETF. It also enables us to, for the first time, list ETF products on the marketplace. Because if you are managing an ETF, you need to have the guaranteed fill at the closing price in the market, and that is what the Market on Close facility provides. And it's a facility that the TSX has obviously offered for a number of years. And again, it reduces the cost and reduces the risk of operating an ETF for an ETF manufacturer. Oh, and by the way, we did the majority of the IPOs in Canada last year. Another indication of how. As you can see, this is just a quick summary, and I don't expect to. I'm not going to walk through it, but the information is available. But that pandemic thing was great, wasn't it? $8.5 billion was raised in 2021. We've been, but as you can see, as I mentioned, we did rebound from the lows in 2023 over the course of the last year. And again, primarily driven by investment in gold exploration and other precious metals, as well as uranium. And a lot of that money was raised in the last few months of the year. U.S. cannabis also continues to raise some money, largely debt financing. And again, they're obviously having tremendous challenges building their businesses. At one point, there was going to be tax relief, potential for access to banking services, and every time they turned around, somebody was pulling the rug out from under them. And I think the consensus building in the United States is that it will be status quo at best for the next 4 years under Mr. Trump and the Republicans. Again, as I mentioned, trading got better as the year progressed. And again, we're hopeful that that is a leading indicator of more activity to come this year, and in particular, more listings and more investment in the issuers listed on the Canadian Securities Exchange. We also launched, or at least we got CSE 2, which is our second book. So we, again, I promised not to go into the Canadian micro market structure conversation, but basically we have 2 books. And the idea here is that, oh boy, I've opened the trap door, haven't I? Let me back up. In the United States, do you know why trading is free? Because people like Robinhood and Webull and all of these disruptor brokers, they actually get paid by Citadel and Virtu and Jane Street and Jump Trading and these guys for their orders. They get 1/10 of a cent a share, and they guarantee the client of that broker tenth of a cent price improvement over the best bid or best offer showing in the national market. So that's why for those of you who trade stocks in the United States through one of these facilities where it's a zero commission type thing, you get these really weird percentages and decimal points. It's like, I thought I was trading in round penny. No, you're actually getting a tenth of a cent from your broker inside the national market when your trade is executed. And then these so-called wholesale brokers operate inside the market to basically lay off the position and try to figure out how to make money on that penny or that half penny spread. So it involves a lot of technology, a lot of smart people who used to work for NASA or used to figure out how to blow stuff up. But it's more lucrative to work at one of these places. And unfortunately in Canada, that type of practice is illegal. But we have uncovered means, capitalism will always find a way, of being able to permit companies which have substantial agency order flow to monetize that. In some cases, we pay people when they lift an order, and sometimes we charge them when they lift an order. And to do that, we have to have two books with differing price methodologies. The long and the short of it is, we've cut costs dramatically for dealers trading in Canada and improved execution quality and costs for the individual retail broker. And it's not just us, this is across the industry. There are a lot of books, it's very complicated, but the bottom line for an individual retail investor is lower costs, better quality execution. So, coming next at the Canadian Securities Exchange. So, as funding conditions were difficult in Canada in late 23 into 24, we saw our issuers moving more and more international. They were going to the United States for capital. They were going to the UK, to Europe. A lot of issuers, especially in the battery metal space, were going to Australia. You know, the lithium, the graphite, the copper, nickel, zinc folks were telling me that the streets of Sydney and Melbourne were, in Perth in particular, paved with gold. Oh, they love us down there. The valuations were getting enormous. So we had to find relationships in those different markets to, whether it's facilitating dual listings or facilitating trading, so that if an Australian investor puts $10 million into one of our issuers, that they're able to trade that position without undue cost, risk, uncertainty, and so on, that they have direct access to our market to be able to manage that position. So that means that we have to wear out a lot of shoe leather, going to these places, engaging with the local brokerage community, with exchange partners in these markets, to provide the lowest cost channels to enable our companies to be able to either list in those markets and be able to manage all of the issues associated with, well, I've got to comply with Ontario law, BC law, and Australian law, or UK law, or EU law. It's a real challenge for a startup company that doesn't have the experience necessarily or access to the advisory that a gigantic multinational would, to be able to manage those. So we're trying to make it as easy as possible. And we've made a lot of progress in terms of adding access to from different funding sources and liquidity sources in these different markets. And that's going to continue to be a focus this year because our companies are continuing to go more and more international. I spent a lot of time late last year talking to the industry and talking to government officials and the regulators about the naked short selling crisis that the junior capital companies, in particular the mining folks, believe is happening. And whether there is a boogeyman under the bed or in the cupboard or whatever, scaring the hell out of your investors or your company, the reality is there are a lot of loopholes in Canada that would permit abusive short selling that aren't available to investors or at least traders in a lot of other jurisdictions. And so we really had to level set our regulatory approach to short selling with the United States, with Australia, and with the UK. And over the course of the last year, we are almost there. And the final piece of the puzzle, again, not going to get down into the weeds, but it's a back office process that is, again, used in the United States. We're going to adopt it here. It's out for comment at this point. but I believe that we have given the regulators all of the tools that they need to constrain abusive short selling, particularly in the early stage capital markets. The question now is whether there is the regulatory will to actually use those tools to actually, enforce the rules in favor of the companies. We have a lot of financial strength. I mean, we've been profitable for a number of years at this point, and we have added to our capital on an annual basis for the last 10 or so years anyway. And that gives us the opportunity to invest not only in our own business, but with businesses that we believe will help us and our customers achieve their goals better as well. And we obviously work very closely with the team at Urbana on these opportunities as they arise. And you'll be hearing shortly from my colleague Didier Lavallee from Tetra Trust. We have an investment in Tetra. I sit on the board of Tetra. And again, this is a company which is building the bricks, the mortar, the picks, and the shovels to bring digital assets into the mainstream, providing necessary infrastructure in the form currently of custody services, providing the level of security that prevents the kinds of hacks that you read about all the time, but with an opportunity and understanding the nature of the business and the assets to extend products and services to serve new markets in I think, a really exciting way. Some of the other things that we're looking at, we have an investment in a company called Dealmaker. It used to be called crowdfunding. I'm not sure what they call it now, but capital formation for early stage companies. And they've really found a niche in the United States. And we think it's a tremendous opportunity for Canadian companies who can avail themselves of capital formation opportunities in the US through Reg A, Reg A+, and a variety of other exemptions in the securities legislation in the United States to be able to pitch and get money from retail investors and other folks in the United States at a very, very attractive cost. And so again, we partner with Dealmaker not just on, again, helping them support their business through investment, but with events in different key markets around the United States to, again, help better promote, raise awareness for the Canadian Securities Exchange generally, and for the issuers that are interested in pursuing these opportunities specifically. So again, because I'm standing up here, I get to give my outlook for, and I am an optimist when it comes to just how things are going to play out. I made a joke about, probably a bad joke about COVID, but the reality is that markets thrive on uncertainty and fear and greed. And we've got the place where people can express those ideas, those concerns, invest in the ideas that will resolve some of these concerns. We do best when the outlook is uncertain, because everybody's got an opinion, and a lot of them will be different. And the old joke, it takes two to make a market, comes through in spades. So again, as I mentioned, our role is to basically open as many channels as we possibly can, not just from Canada, but from around the world, to enable our issuers to ultimately provide liquidity to their investors and reduce their cost of capital when they come back to the markets to raise growth capital. And again, if we're here providing those services in a way that meets their needs, again, we will succeed no matter how crazy things get. And in fact, in some respects, the crazier, the better. But there are going to be some massive changes, and I think it sounds like a cheap shill, but I agree with what Tom said. We've got a lot of companies on the Canadian Securities Exchange who are either looking for or producing commodities that are priced in US dollars, but their costs are in Canadian dollars. That's going to be a fantastic opportunity for many of these companies. I also think that sooner or later, after the Canadian dollar has taken its licks, which it's going to hard, there are going to be a couple of things. One, last time the Canadian dollar took it on the chin, within weeks we saw Google, Facebook, all of these major global US-based companies taking up hundreds of thousands of square feet of downtown office space, hiring engineers out of the University of Waterloo, U of T, Queen's and Western for development labs because the kids were cheaper than they are in the Valley or anywhere else in the world, and they're every bit as smart and capable. So again, these dislocations may be short-term, but again, as I said, the beauty of capitalism is that those inefficiencies will be found and the opportunities will be exploited. And again, I talked about being an optimist. I mean, here I am. I've been my career on Bay Street is only half as long as Tom's. It's 40 years at this point. Oh, thank God you laughed. But I've had the privilege, yeah, that's right, it came to an end today, but I've had the privilege of either being in the front row or more often down in the arena of some incredible innovation. So many of you know I started my career at the Toronto Stock Exchange. We invented ETFs. And yet I know, as being an ETF guy 25 years ago running the program at the exchange, what's been done now. And our colleague Raj Lala is going to be talking about it shortly. What they're able to do, they are so efficient, so lean, so quick, so entrepreneurial that they can meet an investor need in weeks or days that would have taken years back when we were running these behemoth ETFs in the multi-billions of dollars. And they don't have to rely on the distribution networks of the big banks to get the product into the hands of investors. It's fantastic. I talked about Didier. Again, team quietly building the necessary infrastructure for the adoption of digital assets more broadly in the Canadian investment industry. My colleague John Willick. Blue Ocean is nominally a US venture, but with a healthy Canadian content, bringing US trading to the world. And shockingly enough, it seemed to be a good idea that maybe Australians, Koreans, Japanese, Chinese, Singaporeans, Malaysians, and so on would like to trade US stocks in a continuous auction market. Well, it's daylight. It's a fantastic idea. And so what I'm trying to say here is that the ingenuity represented by the companies in the Urbana portfolio is representative of the kind of ingenuity and entrepreneurship that is available in the Canadian marketplace. And so whatever gets thrown at us, I'm confident that, there may be some rough days and weeks, but that, we have the opportunity to emerge stronger than ever. And then ultimately, again, when regime change happens, if regime change happens, there's a realistic possibility that, the Canadian oil and gas industry will be unleashed. We will find new markets, and the global currency trading crowd will discover that, or will remember that the Canadian dollar is in fact a petrodollar, and we'll see renewed strength in the Canadian dollar at some point in the mid to longer term. That's pretty much it. I thought I'd close with a nice picture that I took a week before last in the Chamonix Valley. That's a moondog and light pillars. And not to boast, but I am the world age group champion in the Stock Exchange Ski Championships, and I do have a gold medal back at the office if you're interested in viewing it. Thank you. And you should consider yourselves lucky because I did inflict a picture of me in a speed suit in a GS course on the staff team. So, as I say, unfortunately. How am I doing, Liz?
5 minutes.
It says 7 over there.
Yeah, well.
Okay. In any event, enough about my skiing exploits. I'm happy to answer any questions that you might have about anything.
You mentioned that you're leading, I guess you got the majority of IPOs coming through the CSE. How are you attracting businesses that are looking to IPO? What's the advantage of opening on on the CSE?
So really the key issue is this. As has been reported, there have been maybe 2 IPOs on the Toronto Stock Exchange in the last 2 years. Almost nothing is coming out of the private company side in the larger scale companies. And I think if you want to look at why that's the case, the class of tech companies from 20 to 23 and the fact that almost none of them traded above their IPO price was a significant issue. Our strength is, as I mentioned, in the early stage company space. And people have finally realized that the reverse takeover may not be the optimal way into the market, that you acquire shareholders, but you acquire shareholders who didn't buy your story, right? They bought somebody else's story. And at the first sign of any interest or any buying interest, they're selling, man. So there's effectively an overhang on the share price following the listing of the new company on the marketplace. So the credit to the legal, accounting, and the advisory community in Canada, they have reduced their costs to make it fiscally possible for a small company to do an IPO. Broader distribution, better liquidity post-time, and everybody that's bought in on the initial offering, of course, is buying your story. So you have advocates in the marketplace right from the get-go. So that's been, I think, the big change is that we've seen smaller companies opting for the IPO process, which, as I say, I think is both in the short term and the long term a healthier way to get to the market than previously, whether it was fundamental business change or reverse takeovers. I'm pretty sure Brendan had a question.
Now, about this age thing. But, I don't mean to gild the lily here, Richard, and excuse me for this, but and to answer Max's question, I used to say, and I've had experience, I was the governor of the Toronto Stock Exchange and involved in CSE as well, that we had a secret weapon at the CSE, and that is we're nice to our customers. And it may sound bizarre to say that, but we welcome new listings. We help you to do it. We do it cost effectively. We do it efficiently. And you can have all the liquidity you want. It doesn't matter where it's listed. It's the following you develop. But it is a process that the team at the CSE has perfected to the extent that they are welcoming in your call. They're not finding reasons of why not. I always keep joking. There are 2 types of lawyers in the world: the can't-dos and the can-dos. But the CSE is a can-do exchange, and they don't implement roadblocks, et cetera. And frankly, at the venture, at the other exchange, I think they're ambivalent about smaller companies, frankly. But at any rate, we're nice to our customers. That's the secret sauce, in my opinion.
Question up here.
Richard, you mentioned that we may return to the strength of a petrodollar, but prior to that, what sort of dollar range do you envisage?
I have no idea. But what I will say is, says the guy who's presenting his budget to the board with a Canadian dollar. So actually, let me answer your question a little bit differently. Interestingly, we have significant U.S. dollar revenues, which actually exceed our U.S. dollar expenses, which is cool. So we actually have no exposure to the currency fluctuations from a business risk perspective. What do the smart guys have it at? 61, 62 cents is not out of the question. But again, I think we're going to see, Mr. Trump's policies are likely to be inflationary, and he's going to try to hammer to the extent that he can, the short money down as far as he can. So that should actually start to redress but again, when you see the activity in the US 10 and 30 year, they're all saying, no, we see inflation coming hard. And the yields have been increasing quite dramatically. So again, it's going to be very, very, very chaotic, and that's just, that and $5 will get you on the TTC. Brendan says he's giving me the thumbs up. No. Okay, you get one question, Brendan.
I have one quick question. Now, you are an optimist because you think there's going to be regime change in Canada anytime particularly soon. I will bet anybody in this room there's not a federal election before the autumn. I'll bet them the cost of lunch, say. But there will be an Ontario election, presently. If one had the opportunity to speak to an MP or an MPP about the issues most important to Canadian capital markets and the growth of our country, which is really what the CSE is about. It's about growing Canadian entrepreneurs and the lifeblood of the economic engine of this country. What would be the issue you'd want to raise with an MP or MPP without favoring any political party? What's the issue?
Yeah, that's a phenomenal question because I do get a chance to speak to MPs, MPPs, and cabinet ministers and so on a more often basis than I'd ever expected. And it's a difficult problem to say, okay, so what's the one thing? The issue, of course, is the securities markets is worth about maybe 14 votes in the entire province. So, most of the time they really don't care. But from a federal level, reverting the capital gains inclusion changes back would be a nice start. Ending the double taxation of dividends would be an even more radical approach, but would be a powerful tool to encourage investment and business growth. And from an Ontario perspective, it's not actually in the securities market. It's get your act together on the mine permitting process. It takes 20 years on average from the first time that drill goes in to a producing mine, and that's when everything goes right. The governments do not have their act together when it comes to all of the different approvals and everything. They tend to do them sequentially as opposed to, there's no reason they can't do them all together. And so reforming that process has the potential to turn Ontario into what they're telling us it already is on television, the northern resources powering industrial might of the South. Okay, that's a nice story, but let's actually do something about it. The other piece of that puzzle, of course, is infrastructure in Northern Ontario, because the chromite and nickel and the Ring of Fire aren't going to fly, rail, or drive themselves to markets. Right now, it's sitting 600 miles from a railhead in Thunder Bay with the muskeg and moose pasture in between. So again, there has to be a real commitment on the infrastructure side to support mineral production in the province.